Hello, sir. Mati Shekaran, sir.
Hello. Sandeep. Sandeep. Sandeep.
Hello.
Hello. Sandeep. Are you able to hear me? Hello. 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 You have kept. You are on mute. Sandeep.
Sir, am I audible?
You are audible, but are you able to hear me?
Hello.
Are you able to hear my voice? Hello. Sandeep.
Hello.
I am able to hear you, but you are not able to hear my voice. Hello.
Okay.
Hello.
Sir, am
Sandeep.
I audible now? Yes, sir.
You, you are audible, but are you able to hear my voice?
Yes, sir. Yes, it's
Okay.
audible.
Okay. 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 Fine.
Hello. Sir, I just wanted to speak to you, sir, in this the presentation.
Uh,
Hello. I
yes.
made
Yes.
these three, four slides extra. You just go through it, sir. First two slides would be I will talking and introducing you. This I will be giving the disclaimer.
Uh,
You will start from here
yes.
and you will continue till the time you finish it
Uh,
till 13th, I think.
yeah. Yeah.
Till here, sir. Do and don'ts.
Yes. Yes.
Then
Yes.
16th, I will be taking over from here. And I have the
Okay.
few question answer session lined up.
Right. Right. Right.
One, two, or the participant has to give the right answer for this.
Okay. Fine.
And after this, we will take up the question answer session. Anybody, if you have any queries, and they can talk to us.
Okay. Okay. Okay.
Okay,
So till
this
then,
is how the present whole event will go.
till then, I will keep going, isn't it? Once you hello, hello, Sandeep.
Yes, sir. Your voice is a little bit breaking in by. Your voice little bit breaking, sir.
I do not know why. That is why I am also wondering. Is it
As I
not
know,
coming?
now it is no, it's now loud and clear. But if it is little bit loud on from your side, that will be great because it is
Yeah, yeah. Yeah, my voice is always louder, but I do not know why it is breaking. I will just check.
talking about the mute button, mute volume
No,
button,
no, no, mute. I am not on mute. I am not on
volume
mute.
button.
Volume button where it is. Okay, the laptop का volume है.
Uh,
Yeah, full volume I have kept.
For at your laptop or your desktop, whichever device you are using.
Yeah, I have kept
Okay.
full volume.
Okay, sir. Right. Okay.
Okay. So you will say something about these 3 4 slides at the beginning,
Okay.
and
Right.
then you
Thank
will
you.
give it. Okay, thank you. Bye.
Okay, sir. Right. Hello.
Yes, yes, Sandeep.
Hello. Okay. Me. Sir, tell me, sir.
Yeah, no, you were asking me. I thought
No,
you
no.
are
I
calling
was
me.
just uh, uh, well, we have a few disclaimers and before starting of the session.
Okay, okay, okay.
Hello.
Yes,
So
yes.
I need to go through it, and then you can start with the I will introduce you, and you can start the session. That's it.
Okay, okay. Other participants are
Okay,
already
sir.
there. Participants have
No,
come.
sir. No, no. Only we two are there.
Okay, okay, okay. Sandeep. Ah, I see. Okay, okay. So I have to talk in Tamil. Huh? English. Okay. Ah, uh-huh. Chat box. I have not used this in the past. This is yeah. Ah, okay, okay. How many people have come? Acha, acha. So I am unable to see them. I mean, Sukhvinder, one person is there. More. Where I have to click? 1 minute. Acha, let me see. Reclaim host role, change audio connection, polling, find device audio setting, source. Some pictures of the Maji Firmi marketing host Sukhvinder. Only three people, participants, three. Ah, ah. Huh? Acha, this Mr. Sukhvinder is. Okay, Ritik has come. Darshita is there. They're all they're all on mute, I think. Okay, so initially I will start English. I will ask them in the slowly. Okay, I will of course make them to feel home. Okay, no problem. record ஆகுதா பேசாத.
Good evening, dear participants. I am Sandeep Dubey. We will start the presentation in 5 minutes. Good evening, dear participants. I am Sandeep Dubey. I welcome you all to this investor education program sponsored by Investor Protection Fund Trust. Before I invite our guest speaker, allow me to inform you all you will be in a view only mode throughout this webinar. You will have
Sandeep, not audible. Sandeep? Sandeep, you are not audible.
Sorry, that was.
You are not audible. Sandeep?
Hello.
Hello, not audible.
Hello, am I out?
Yes, yes, yes.
I'm sorry for that. Just to make this a session interesting and very interactive, we have a few questions lined up at the end of this session, wherein you will find four choices. You need to give the correct answer in through our chat box. And the let me remind you, this presentation is in general and is meant for educational purpose only. And if you have any further questions or concerns in the meaning or the application of a particular act, rule, or regulation, or circular refer herein or about any terminology, you can take the professional advice. Well, let me start the presentation. Here I invite Mr. Matishekaran sir, who is a retired Forward Market Commission member. Matishekaran sir, I request you to take up the session here on now.
Yeah, thank you very much, Mr. Sandeep. First of all, good evening to all of you. At the very outset, I would like to extend a very warm welcome to all the participants on my behalf as well as on behalf of NCDX. And I take this opportunity to convey my sincere thanks to NCDX also. The very purpose of today's, the main topic today is hedging mechanism for mitigation of the price risk. See why this topic we are discussing today and what is the purpose. That is what I have stated in our first slide. Commodity futures market, is an institution of market infrastructure, which links a host of commodity ecosystem, entailing warehouses, cold storage, banking, insurance, assets, and so on and so forth. Actually, commodity futures market is less understood and misunderstood by people. When I say less understood and misunderstood, there are some reasons. Basically, the commodity futures market, originally when it started on its own in the past, even before, even during the periods of Arthashastra, such type of trades were going on. But later on, during Second World War and all, due to price crashes in agricultural commodities, people thought of doing this type of trade. But actually, in 1952, when the Forward Contracts Act, Regulation Act 1952 was passed, the main intention was to protect the interest of the farmers because they were not getting remunerative prices. Suppose the prices are going up and up, there were a hue and cry. Why the prices are skyrocketing like that, etc. But people are not understanding that increase in prices are good for the farmers. But on the one hand, farmers are not getting remunerative prices. On the other hand, the participation of farmers is very, very less in this market. You will not find, a genuine farmer actually involved in the commodity futures market trade. Only on behalf of farmers, some farmer producer organizations may be there now. But earlier, farmers' participation was comparatively very, very less. Then this market is supposed to have, is supposed to be based on speculation. Speculation is the backbone of this commodity futures market. But speculation, most of the times in this agricultural commodity future market, remains unscrupulous. Speculation is a must for facilitating any trade. Suppose if you and I alone are there in the market, there will not be any trade. The trade won't take place. Suppose I want to sell a commodity at a particular price, and you are there in the market, you want to buy that commodity, but you are not getting the price. I mean, I am quoting some price, you are not ready to accept that price, you are not ready to buy that price. So you are not finding a ready seller for your product, and I am not finding a ready buyer for my product. So as a consequence, if we both alone are existing in the market, trade does not take place. But the third fellow, the speculator, comes into the market, he accepts the risks, he shoulders the responsibility. That person's role is very, very vital. But unfortunately, in the commodity future market, that role has been more of unscrupulous in nature. So another problem. So then the forward markets, the forward market should have perfect competitive environment. That means there should be a perfect competition prevailing in the market. But I mean, for that there should be large number of buyers and large number of sellers. Actually, only top 10% of the players dominate the market. That means there is no perfect competition prevailing in the market. Then genuine hedgers participation is also very less in this market. Genuine hedgers, who are the genuine hedgers? Exporters, importers, stockists. So these assayers, so these people's presence are very, very less, comparatively less. And there is a regulation. Commodity futures market is being regulated by three-tier setup. At the apex level, Government of India is there, Ministry of Finance, Government of India. And then SEBI is there. It is the secondary, middle level regulator. Then the third level regulator is the exchanges. So these three tier regulation is framed in the setup, but yet the regulatory measures are not working well at times. For example, in the case of commodity guar seed and guar gum, in the year 2012, when the prices were skyrocketing, for example, in the commodity guar seed, for 1 quintal, it was at that time in 2012, December, something like that, it was 8,000 rupees. But within a month's time, the price went up to 30,000 rupees. Same manner, the gum's price, which was ruling around 30,000 rupees, in a month's time went up to 1 lakh rupee. So this type of skyrocketing was going on. At that time, the regulator wanted to put a break for this type of increase in the prices. But they applied all sorts of regulatory measures. In fact, they went on increasing the special margin. Even 86% the special margins were imposed, but yet the price behavior did not obey the orders of regulation. So there were a lot of problems existing in the commodity futures market, and that is why it is required that this subject should be understood in a clear-cut manner, so that you people will be able to, when you are actually working in the field, you actually involved in the trade of commodity futures market, you will be able to do the trade in a very good manner, better manner. That is the purpose for which this type of training sessions have been organized. And so you will find the price discovery in a more effective manner. When these type of things are discussed, your hedging mechanism will be very sound enough to mitigate the price risk. That is a purpose for which we are all now sitting here and discussing. Now, hedge trading, there is a history. See, futures trading or hedge trading is going on since time immemorial. Even similar type of trade, I already said, similar type of trade was going on even during Chanakya's period. Even in Arthasastra, there has been a mention about such type of trade. Those days, it used to be more among the close-knit groups, means among the relatives, friend circle, etc. But whenever some default happens, nobody was there to guarantee. But that was the reason this type of trades always ended up in failure. But organized forms of futures trading in the country, in India, started in the year 1875 in the commodity cotton in Bombay Exchange. And later on, it was going on mostly like double trading. So people, means government wanted to regulate it. That is why FCR Act was passed in 1952. And afterwards, they permitted 5 commodities: pepper, turmeric, castor seed, gur, potato. These were the 5 commodities in which this trading was allowed. Although 118 commodities were covered, but in the 5 why they were restricted to 5 commodities? They were afraid. I mean, the government was not comfortable, or the regulator was not comfortable to allow more and more commodities to be traded in the futures market. If suppose essential commodities are there, they will get afraid that essential commodities, if we allow the futures trading, the price will be skyrocketing. We may have to face the scathing attack of people, parliamentarians like that. So there was always a negative thinking about futures trading in agri commodities. But certain commodities in which the merchandising contracts were permitted, genuine merchandising contracts. What is the genuine merchandise contract? The TSD and NTSD type of contracts. The TSD means transferable specific delivery contract. NTSD means non-transferable specific delivery contract. Suppose if the contract is between A and B, and the right of the contract cannot be transferred from one party to another, means it is only non-transferable specific delivery contract. A and B enters into a contract, and they themselves have to finalize the contract, perform the contract. Whereas a transferable specific delivery contract, it goes on to various people. Finally, between the first seller and the last buyer, the contract gets settled. So this type of trades were allowed for ensuring the supply of raw materials like jute mills, cotton mills, etc. They wanted to have their supply, uninterrupted supply. So for them, this was very much useful. Genuine physical trade and physical market players enjoyed this type of NTSD, TSD contracts. Later on, various committees have been set up by the government, and such committees have recommended, each and every committee set up for the purpose of improving the futures market, all recommended for going in for more and more commodities to be traded in the futures market. So finally, government took a decision, and as a consequence only, multi-level commodity exchanges have come in. So multi-level commodity exchanges like NMC was the first commodity exchange set up, then MCX and NCDX and all, ICX, UCX, etc. Now the NCDX, NCDX is now indulging in agricultural commodities more and more. They are the main exchange, providing facilities and help to the farmers through hedge trading, hedge contracts, and a number of almost 36 commodities they have permitted to be traded on their platform. So after merging with SEBI, earlier this was regulated by the Forward Markets Commission, which was a separate regulator. Recently in 2015, this market was, Forward Market Commission was merged with the SEBI. So it is being now regulated by SEBI, just like a financial product, any other stock. So even Bombay Stock Exchange, National Stock Exchanges, they are also conducting futures trading in this commodity. Now NCDX, which was established in the year, next slide. Sandeep, next slide.
Yes, sir, I'm doing it.
Yeah. See, this NCDX, which was established in the year 2003, is the leading exchange, I have said. There are more than 1,000, almost 1,000 or more members, and 1,000 centers in the country, and almost 20 lakh clients will be there, I think, or about 500,000 terminals also may be there under NCDX, providing a futures trading platform. So NCDX helps farmers to price their goods more accurately, even though they are not active in futures. Commission agents earlier used to have big control over the price information, but after NCDX has come up, the cost of price data for farmers has come down. NCDX has standardized quality specifications for agri goods through hedge contracts. Large participants also use NCDX platform to hedge and speculate. Now, for this commodity, in this type of hedge trading, main problem we face is commodity prices. That is why this hedging, etc., we are talking about. So what is this commodity price risk? whenever price changes, either price increases or decreases, it will cause loss to buyers or producers. When prices go up, buyers will face risk. Example, suppose if you are a furniture manufacturer and when price of wood goes up, you will have problem. It will affect your profit. And as a farmer, being a producer of some crops, when price go down, they will get affected. So commodity price risk is nothing but a chance. It is nothing but a chance that commodity prices will change in a way that causes economic loss. For buyers, it is due to the increase in prices. For example, during the first half of 2016, steel prices jumped by 36%. Natural rubber increased by 25%. So, auto manufacturers had a negative impact on their profit margin. For sellers, it is often due to increase in prices. For example, from June 2014 to January 2016, oil prices fell by 70 cents per US barrel. The fall in prices of crude oil had reduced. For example, one of the companies in France whose total operating cash flow was about 17 million. So that is how fall in price of crude oil has impacted. Now, this uncertainty, volatility is one of the main problems, and that creates uncertainty. So commodity prices are characterized by volatility. Volatility creates uncertainty about futures revenue from commodity sales and exports. Between September 2008 and September 2018, the average spot price of Brent crude oil, for example, fluctuated between 124.9 US dollar and 30.8 US dollar per barrel. In 2008, it was 124.9 US dollar, and 2018 it came down to 30.8 per barrel. So this is how the crude oil fluctuated at that time. So the average monthly price of, for example, copper at London Metal Exchange fluctuated between 9,868 US dollar and 3,072 dollar per ton during September 2008 and September 2018. So agriculture prices were all volatile. Example, during the above period, I mean during the same period, means September 2008 and September 2018, the average monthly indicator price of international coffee reached a high of 231 US cents per pound and a low of 98 US cents per pound. Similarly, UNCTAD Commodity Price Index also reveals monthly changes as high as 12% and a low of minus 19% during the period from February 2000 to September 2018. So these figures illustrates volatility of commodity. Now, how to mitigate these risks? So commodity as the commodity futures, they are the tools for mitigating price risk. So how there are some studies, some people have conducted research studies, and they are saying commodity futures are acting as a tool for effective mitigation of price risk. For example, Naval P 2008-17 has examined the price discovery function futures market in a futures market of agri commodities. He studied chenna, soybean, and pepper futures, and his study reveals there is a significant relation between futures and spot prices. Similarly, Professor Irani SK in 2017 investigated price discovery and efficiency of Indian futures market. His study reveals futures market is more dominant in the price discovery process. That is why he advised the policy planners of the government to encourage futures trade in agricultural commodities. Same manner, Professor Narasimhalu and Satyanarayana in 2016 studied the futures contract in chenna, chili, and turmeric. Their study also brings out the picture that there is an existence of a long-run relationship between spot and futures. Similarly, Balasubramanian and Nambiar in 2016, they studied rubber market price behavior and found out that rubber farmers are benefited out of futures trading. Here in the case of rubber market, I would like to say that these people nowadays, they have got rubber, farmer producer organization, FPOs. And these are the first people who have organized in Kerala. Rubber farmers are the first ones to have organized farmer producer groups. So they collectively, because in the futures market, commodity futures market, because of margins and other charges, it is very difficult for any ordinary farmer to enter into futures contract. It is difficult for them to enter and trade. Collectively, by organizing farmer producer organization, they joined and they innovated. In fact, they were the first pioneers in doing this. So in that rubber market also, the study done by Balasubramanian and P. Nambiar brought out the picture that rubber farmers are benefited out of futures trading. And similarly, Edward J.A. and Rao TVN in 2013, they studied Chile futures. And they found out a unilateral relationship between spot and futures of Chile. Actually, futures and spot should converge. So they should travel in the unidirectional direction. So that sort of this thing they have found out in Chile contract. So it is an interesting study. Similarly, Reserve Bank of India, in their report, annual report 2009 and 10, they have examined urad, chana, dur, wheat, potato, and sugar futures. So their study, the period was 2004 to 2009. So they have concluded that the futures trading should be seen as a tool to make market more efficient. Futures trading should be seen as a tool, not future study. Should be seen as a tool to make market more efficient. Similarly, AC Nielsen, they have conducted study at the instance of NCDX in the year 2007. What they have done is they have selected samples near area of the price ticker board. They have got the NCDX has established price ticker boards in the areas where the futures tradings are going on. So wherever the price ticker boards are there, from nearby that they have selected some sample farmers. Similarly, slightly far away from the ticker boards, wider area sample. So again, they are also farmers from the wider area. So they collected both near area farmers as sample and wider area farmers as sample. And the near area sample farmers are saying that we were benefited out of futures trading because we go by the ticker boards prices indicated by NCDX, and only after seeing we decide whether we have to sow this crop or the other crop. That decision we take only after seeing the ticker boards of NCDX. So like that, the Nielsen study also proves that price discovery, hedge trading does very wonderful job. And what are the actual tools that the tools of commodity derivative tools means it is commodity derivatives in this hedge trading. So in the globalized economy, it offers new markets. Everyone you will find new markets, new potential clients, new profits, which of course includes threats and risks also. In a situation of domestic or regional market, price is determined within the individual market based on the local or domestic prices. But in the case of globalized largest market, price is the outcome of factors from different parts of the world. For example, the price of wheat, corn, soybean, or oil seeds does not depend upon local conditions alone. The increased volatility in prices is the main concern. To address this increased volatility in prices, the available hedging tools are forward, futures, and options, which are all derivatives whose value is derived from the underlying asset. Forward, I have already said forward. See, when you say forward, is a contract. It's a contract. When you talk about forward, what is forward contract? You need to define. Forward contract in the act, it is defined as forward contract is not a ready delivery contract. This is how it is. In an indirect way, they have defined forward contract. If it is a ready delivery contract, then what is it? Ready delivery contract? Ready delivery contract means anything in which when you buy a commodity, the payment and the delivery are made within a period of 11 days, then it is a ready delivery contract. So anything in which payments and delivery are not done, any transaction in which payments and delivery are not done within a period of 11 days, that becomes a forward. So forward is the contract through which hedging is also done. And however, it is not a standardized contract. It is simply tailored to the client's individual needs. It is not a ready delivery contract. It is not a standardized contract. It is simply an OTC contract and are negotiated between parties on OTC markets, over the counter markets, in a decentralized manner. So transaction costs for hedging price risk using forward contracts can be higher than futures, because futures are highly standardized contract. Transaction cost naturally will be more in the forward contract, which is not a standard contract. The quality, quantity to be delivered, time at which it should be delivered, place at which it should be, everything is standardized. It means it is the standardized contract, and it is a hedge contract. I am talking about the futures contract. Futures contract is a standardized contract. So forward contracts typically result in physical delivery. They are mostly used by physical market players for their genuine merchandise contracts. As I already told you, the TSD and NTSD contract, transferable specific delivery contract, non-transferable specific delivery contract, are all forward contracts, which are genuine merchandising contracts meant for ensuring the uninterrupted supply of this raw materials. So the futures contract is a highly standardized contract. Then it is hedge contract, exchange traded contract, and the counterparty trading, counterparty guaranteed, counterparty risk is guaranteed in this futures contract. So that is the difference between forward and futures. And most of the commodities doing in which hedging is going on are all in futures contracts, not in forward contracts. Then another derivative is the options contract. This options contract is nothing but, when an applier pays the premium for the right to buy or the right to sell the underlying commodity at a specified price on or before the expiry of the commodity. For example, it is a standardized derivative contract. Just like a futures contract, options also is a standardized derivative contract. It gives the option owner, means he is the holder of the option, the right to buy or the right to sell. So he has the right to demand delivery. When a person owns the contract right to buy, he has the right to demand delivery of the underlying asset. The buyer of the option pays the premium and exercises his rights. The buyer of the option pays the premium, and he can exercise his rights. The seller of the option has the obligation to deliver. Seller of the option receives the premium. So for the buyer, the risk is limited to the premium. Profit is unlimited. For the seller, profit is restricted to the premium. So there are two types of option here. One is call option, another is put option. So futures price is in the option. Futures price is the underlying asset. In the Indian option, right now in various exchanges like NCDX, BSE, NSE, option trading is going on, in which the underlying is the futures contract. The ongoing futures contract is the underlying asset. And the commodity option in India is European style, in the sense settlement at the maturity of the contract. But in American type of options, settlement will take place in between. So this is the third tool, which is which is one of the important derivatives tool used for hedging. Now let us see what exactly a hedging is. So basically, hedging is a sort of insurance. Hedging is a sort of insurance. please come to hedging. When you decide to hedge, you are insuring yourself against the negative events impact. I have gone to hedging, Mr. Sandeep, hedging example. So when you decide to hedge, you are insuring yourself against the negative events impact. This does not mean that you can prevent all negative impact. If a negative event does happen, and if you are properly hedged, the impact of the event is reduced. For example, portfolio managers, individual investors, and corporations use hedging technique to reduce their exposure to various risks. In financial market, hedging is not as simple as paying an insurance company. Hedging is basically a technique that is meant to reduce potential loss, and it is not to maximize your potential gain. Please remember, hedging is basically a technique that is meant to reduce potential loss only, and it is not meant for not meant for maximizing your potential gain. And hedging is done through using the derivatives. When a person wants to hedge a risk, the objective is to take a position that neutralizes the risk as much as possible. Here I have given one example in the following slide. Here in the following example, you see, when the wheat price goes down in the spot market from 1800 to 1700, he incurs loss of rupees 100, which is offset in the futures market. Please see the example. Come to the table. So on 30th August 2021, are you seeing? On 30th August 2021, the spot price was 1800 per quintal. Our man, maybe the person who does the hedging here, he has bought in the ready market 1800 rupees per quintal some wheat. And suppose today he has bought this. By December 31st, if the price goes down to 1700 per quintal, means 3 months from now, if the price goes down to 1700 per quintal, what happens? He loses 100 rupees per quintal, means it is a loss to him. So that is why on the day when he buys this 1800 rupees per quintal that in the spot market, he enters into an opposite contract, sale contract in the futures market at 1900 rupees per quintal. That is why even though the prices goes down from 1800 to 1700 per quintal 3 months from now, at that time, since future has, futures price has got carrying cost also. So when the ready goes down, future also goes down. So at that time, from now the 3 month onwards, in December, the future price also 1800 rupees. From 1900, it has come down to 1800. So our person who has done this hedging, even though the price, he has lost 100 rupees per quintal in the spot market today, at the end of the 3 months period, that is on 31st December, he is not at loss. He is able to offset the loss because he is gaining 100 rupees profit in the futures market. So it is an opposite contract. So futures, hedging means in one market you may be a long, in another market you may be short. What you have lost in one market, you have gained in another market. See, in order to avoid possible loss in future, which is arising out of price fluctuation, the loss is arising out of price fluctuation. So you are entering into an opposite contract. That is a hedge contract. That is how these people in agriculture commodities or any other commodity, they are doing hedging. Now, again, the hedging continues. For your hedging to be more robust, what are all the things to be there? See, there are certain assumptions. I would say these are assumptions, whether they are really prevailing or not. But large number, as I have first only said, large number of buyers and sellers should be there in the market. Then only, the market conditions will be robust and healthy, and hedging mechanism, whatever is applicable there, will be effective. And supply of commodities should be large. The commodities in question which is which is being traded in the hedge market, should be large. If a small quantity is the supply, then people will corner it. So it will be very, very difficult. That is why supply of the commodity, even when the Forward Market Commission, even now the SEBI, whenever they are allowing a particular commodity, after examining the production, supply, domestic production, international production, total supply in the globe, everything they examine, and price also they examine, then only they allow the commodity to be traded in the market. Supply is narrow commodity means they do not simply allow that contract to be traded. Then another important condition to have an effective hedging to take place, perfectly competitive market. That means perfect competition should prevail and wide price fluctuation should be there. It is another important requirement for an effective hedging. Then commodity should be homogeneous. Commodity in question should be capable of standardization. So as far as possible, at the same time, the government should not have much control because more and more control means you are not allowing the free market forces to play effectively. The demand and supply forces should play in a more effective manner so that the most competitive price will get emanated in that hedge trading. And since the basic objectives of hedge trading is a price discovery and price risk management, price discovery should take place in the most competitive environment. That is what I am repeating. And discovered prices, now effective competitive environment is there, so prices are getting discovered. The best price got discovered, let us assume. So these prices are the signals for the farmers to decide which crop they should grow in their field next year. So all those things are possible only when market integrity and transparency are ensured in the regulatory setup. So that is why commodity futures market regulator, I mean SEBI, are from time to time introducing different types of regulatory measures. What for? It is to bring market integrity. It is to bring transparency. It is to instill confidence among the investors and the traders. So once they ensure market integrity and transparency, they will protect the clients against manipulation. This is the most important thing. So the regulatory setup should see that clients are not affected. If the clients are affected, then even the effective trading also will not take place. So once they once they ensure market integrity, then they will protect the clients against manipulation. Therefore, in order to have effective regulation, the exchanges, clearing houses, all collect various margins. You may be knowing that initial margins, special margins, concentration margins, delivery period margins, like that, they are collecting different types of margins. All these margins are clearly spelled out in the contract specification before allowing the contract to be traded in the forward market. Now, having said all these things, you as a trader, you as an investor in the commodity futures market, every day you must be knowing and you must be doing also. But I would like to say certain few things, that what you have to do and what you should not do. Some few points. One is you have to trade with SEBI registered intermediaries only, and fill out the KYC form completely and strike off the blank fields in the form. Ensure you have read all the mandatory documents, namely rights and obligations, risk disclosure documents, etc., etc. And you have to get a clear idea of all the brokerage fees and other charges. What are all the brokerage commission, etc.? You should be very, very clear, thorough. And then you please obtain a copy of all the documents form from the brokerage for free of charge. You don't pay anything. You ask them to give you for free of charge. And what are the things that you should not do? Don't trade with hesitance, half-heartedly. Please don't come to the market half-heartedly. Whether I will be able to earn, whether I will be able to make more money, half-hearted things should not be there. You come boldly with a clear idea, and don't trade with the idea of becoming a millionaire overnight. Overnight, you should not try to become a millionaire in the commodity futures market. Of course, it is possible. Some people also have done it, but not all people can gain. Not all people can win. So don't use borrowed money. Don't make any payments in cash to the stock broker. Don't share your internet sharing accounts password to anyone. Okay, and then above all, please have in-depth knowledge about the production, demand, supply, domestic and international price situations. So for that, you have to keep watching the important newspaper or your daily whatever on the nowadays you are getting mobile on hand, all sorts of informations are coming, price information about a commodity in which you want to trade, about its supply, about the marketable supply, everything you have to find out easily. You find out and then you can get into the market. Without having thorough knowledge, please don't do the trade. And do not hold the contract in futures experiment. That is very important. And do not buy or sell contracts that are too far in the futures market. Means avoid using, I mean, these are the important things that you must have to, you must be doing, of course, but you please remember. And with these words, I would like to say thank you for having listened to me patiently so far. Thank you very much. Mr. Dubey, thank you very much.
Thank you,
Continue.
sir.
Thank you.
Thank you for your enlightening session. Here from I have
Some questions.
one couple of
Yes, sir.
slides on turmeric.
Please, turmeric, please proceed.
Yes, yes. Actually, I'm sorry, my internet is lagging today, so
No, no
the
problem.
slide
No,
is moving little slow.
no problem.
Okay. So if you in the previous slide, sir was rightly said that whenever we want to invest in future contract, we need to have an update on the production, supply, demand, and consumption, everything. All the we in short, we should know the commodity balance sheet. Okay. So in turmeric, we have the India is the world largest producer, consumer, and exporter of spices in the world. Uh, India's spices are the most sorted after globally, given the extinguish aroma, texture, and taste, and medicinal value. Okay, so we India export the 15% of its total production. That means 85% we consume in India itself. And most of the importers are Indonesia, Vietnam, and China for turmeric. And turmeric is the third most important spice, contributing 10% by weight and 6% by its value in total spice exports. So, curcumin content, color of the finger bulb, width and length of the finger determine the value of the commodity. If you want to purchase turmeric, you need to see this curcumin content, color, and length of the turmeric, and these factors determine the value of the turmeric basically. And we have this base Nizamabad as our basis center, and Rajapuri as a variety in Sangli, and Salem variety in Erode and Baspat, and Kadpa. These are the mainly producing centers and trading centers for turmeric. And we Nizamabad as Sangli and Basmat, we have the delivery centers for turmeric futures contract. If we talk about this contract specification, we have unpolished turmeric finger, Nizamabad, quality X warehouse, Nizamabad, the trading on our NCDX platform. September, October, and November contracts are really active presently, and the basis center is the Nizamabad for the turmeric future contract, and unpolished turmeric finger is being traded. And additional delivery centers for this variety is Erode, Salem, and Rajapuri fingers with applicable premium and discount. We and additional delivery centers would be Erode and Sangli and Basmat, and the tick size would be 2 rupees, and lot size is 5 metric ton. The premium discount, just I talk about, is as applicable as below table. Delivery location would be bus for the Basmat Salem variety. We have 2% premium, and Erode variety 4% premium, and Erode Salem 6% premium, and Erode Nizamabad Farmer Polish we have 4% premium. Sangli Farmer Polish, Nizamabad Farmer Polish 4% premium, and Sangli Rajapuri 8% premium. And the quality specification for the turmeric future contract, as Mati Shekaran sir rightly said, we need to standardize our contract. So these are the standard parameters for turmeric future contract. The foreign matter should be 1.1 maximum, and seed and stock 8% maximum, and damaged, discolored, shriveled, and immature seed 4.5% maximum we accept in our commodity parameter. And instant damage matter should not be more than 0.5%, and test weight on count maximum 300 seeds per gram. So basically, these are we as these were the quality specification for turmeric future contract, and we have come up to this question answer session. So we have four questions lined up for you. I just need there are four. Choose the correct answers. You can type in your answer on our chat box. The first question is, who regulates the commodity derivative market in India? Option A, RBI; B, IRDA; C, PFRDA; D, SEBI. I request the participants to put. Yeah, very good. Thank you so much, Surya ji. The right answer is SEBI. Now we'll come up with the second.
But others are not done it.
Yes. Whether the second question is whether SEBI regulates spot market commodity trading also. Option A, yes. Option B, no. Option C, not sure. Option D, probably yes.
Only Surya is answering,
Only
isn't
Surya is
it?
answering.
Others,
Uh, uh,
uh,
I'm sorry for that.
this question,
Whether
you said
SEBI
this,
regulates the spot market commodity trading also.
he said yes, but it is just you telling the answer.
Okay. The answer is no. SEBI only regulates the future markets. And we come up with the third question. Which of the given factors affect the price of the agri commodities? Option A, weather condition; B, agricultural production; option C, changes in import and export policies; option D, all of three. That's good. Surya
That's
garu.
good. Surya, Surya is nice.
Right.
Now one more
Shaka
person is
Suresh.
very good.
Yeah, very good.
Participation is
Yes, good participation. Thank you for your answers. And we have come up with for the last one, protecting oneself against unpredictable changes in the price by shifting price risk to someone else is called. Option A, arbitration; option B, hedging; option C, investing; and option D, none of these. That's great. Very nice participation.
yeah.
And thank you, audience. Thank you for your interactive session. And now we have come up to the end of this session. Before ending up the session, I would request you to post your questions if you have any in our chat box. Sir, the question was, sir, would you advise to hedge by buying put option or shorting call option?
Yeah. Buying put option.
Buying put option would be the suggestible and recommendable one if you are a
Yeah.
farmer, if you hold the stock. And the sec thank you, Vishaka ji. Thank you so much. Suppose if you hold the stock, you can go short on the. Sorry, I cannot, Colleen sir, I cannot give you the annotation, shared content. Sorry. So, suppose if you're a farmer, if you can sell the stock by on our exchange platform by taking a like selling a put option. And again, because it's a premium is because when you trade in the futures, the premium you need to pay the margin. But when you trade in options, you need to pay only, and you are buying in the option. That means you are paying only the premium. So it is very reasonable for you to go ahead and buy the put option. Sir, I don't think, sir, we will have this certificate for this session. This is just an educational purpose. We have conducted this session, and if you, we have a lined up other sessions also wherein we provide the certification for if you attend all the all the modules. I will be sharing you link if you you can contact us on askus@ncdx.com or I have shared my mail and I can share you those webinars wherein we will provide the certification if you attend all the 3 sessions. Thank you. Well, I think that was a great session, sir. Thank you so much, audience, and thank you so much, Mati Shekaran, sir, for your insight on this commodity markets. And we have a few more interesting session lined up. You keep watching our NCDX website and our Twitter handle and on NCDX. Thank you. You been a great audience. Thank you so much.
Thank you, audience. Thank you, Sir Sandeep. Thank you very much. Sandeep, thank you.
Thank you, sir. Thank you.
Thank you, Sandeep. Thank you.
Okay, sir. Thank you.
Thank you,
Thank
sir.
you. We can leave the.
Thank you. Yes, sir. Yes, sir.